Hello and welcome to Crossing the 49th, a cross-border tax and financial planning podcast. I'm your host, Phil Hogan, and today we're going to walk through some common cross-border tax questions. Okay, so today I thought while I'm driving into the office, might be a good opportunity before the podcast studio is completely ready for the next round of podcasts to do cross-border Q&A. So I'm going to walk through 4 questions that I get on a pretty regular basis. First question is going to be about the October 15th deadline. Second question is going to be about crypto and T1135 reporting. Third question is going to be about IRAs and 30% withholdings from US brokers. And the final question is going to be about Canadian foreign tax credits. Okay, so number 1, first question of the day. What are my options if I miss the October 15th deadline? Okay, so this one's quite timely because the final deadline for U.S. tax returns to be filed is October 16th this year. Normally it's October 15th, but in cases where the deadline actually falls on a weekend or a holiday, then it will revert to the 16th. So this year, the final deadline, assuming that you have already extended your U.S. tax return, will be due October 16th. So, most of these questions we're going to go through relate to Americans living in Canada. So US expats residing in Canada. So in most cases, your tax return was actually due June 15th. So if you haven't filed already, hopefully you've already extended your tax return to October. So you would have done that through Form 4868. So assuming your deadline is now October 16th, and also assuming that you think you may not be able to complete the return and file it by that deadline, then what are your options? So the first thing I'm going to say about this is whenever possible, just try to get these tax returns filed. So if you're doing it yourself and you're procrastinating, just get them done, get them out of the way, because the option that I'm going to talk about is certainly an option, but not something that we recommend. So if you can file it on time, file the tax return on time for sure. The second thing I want to talk about is if you are going to extend past October, make sure to file your FBAR. So I'm going to make the argument that the FBAR would be extended with this December extension that I'm going to discuss, but I wouldn't take that risk. So the FBAR should be relatively straightforward to complete. So if you haven't completed that already and filed the FBAR, file the FBAR before you do this extension. So assuming, and once again, if you're getting, if your CPA is filing your tax return for you, and assuming you've gotten your tax information to the CPA in a timely manner, I would really push them to get it done and not extend past October. But assuming you won't be able to meet the October 15th deadline, there is an option to write the IRS and request a December 15th deadline extension. And I'm not going to get into great detail on how to complete that request, but essentially what you're going to be doing is you're going to draft a letter to the IRS. You're going to include your name. You're going to include the tax year in which you're requesting the extension. You're going to include the reason why you're requesting the extension, and that might be because you haven't received all the information required to file the tax return, and you're going to include your social security number. Now, once you draft that letter and you request the extension, you mail that extension to the IRS, and I'll have a link below to where you can mail that letter. So that's your option for filing past October 15th. That will get you to December 15th, assuming that doesn't land on a holiday, to be able to file your tax return. Once again, this is something that you definitely don't want to take advantage of unless you absolutely have to. So I don't advise anybody extend to December 15th unless it's absolutely necessary, and you're in a position where you feel like you can't file by October 15th. Okay, so that was the first question. Let's get on to question number 2. So question number 2, do I have to report my hard wallet crypto assets on my T1135, which is foreign disclosure for Canadian purposes, or my FBAR? So we get this question a lot, and it's often because if you hold crypto in a U.S. brokerage account or a U.S. crypto account or a Canadian crypto account, it's pretty clear where the assets are held, generally speaking. But some clients actually hold their crypto assets in a hard wallet. So just hardware wallet, which is off grid, not connected to the internet. And the question is, assuming you're holding that crypto wallet in Canada, does that need to be included on a T1135 or an FBAR? Now, I think you can make the argument that if you're holding it in a hard wallet in Canada, then it's not foreign for Canadian purposes, but it would have to be reported on an FBAR and vice versa. However, I would always advise, and this would be the case whether it's a T1135 or an FBAR. When in doubt, report it. I don't think you ever want to be in a position where you want to try to make the argument with the CRA or with the IRS that you didn't need to report something on an FBAR or T1135. So my advice is always, when in doubt, report the assets on each respective form. So if you have $100,000 of Bitcoin on a hardware wallet, I would say report it on the T1135 and report it on the FBAR. Now, if the only reason why you're filing a T1135 is because of this, $100,000 of Bitcoin that you own, perhaps there's an argument for not filing the T1135 at all. So make sure to talk to your tax CPA about that filing. But if you're filing the 1135 anyways, I tend to file and report that crypto. It just puts clients in a good position where they know that they've reported the assets and that they're fully compliant. So there's really no downside to doing it other than a little bit of extra work. But I would say, given the potential penalties, especially for the FBARs, I would always report. Okay, so that was question number 2 about cryptos, T1135s, and FBAR. Let's get to question number 3. Now, question number 3 is something that I get asked about a lot, especially nowadays. So I get asked, clients will have U.S. IRAs or 401ks, but mainly U.S. IRAs in the U.S. held by U.S. brokerage, U.S. broker. So let's say they have a $500,000 IRA with Fidelity in the U.S. and they live in Canada. When they start taking distributions from this account, and this is not just Fidelity, but most of the U.S. brokers that hold accounts for Canadian residents, they used to, under the treaty, with if you file a proper tax documentation with that brokerage, to be able to withhold 15%, which is the treaty rate on periodic payments from an IRA, they would withhold the 15%, and assuming you weren't a U.S. citizen, then you wouldn't have to file any additional tax returns with the IRS. So just stepping back a little bit here, if you're not a U.S. citizen, you don't have to file U.S. tax returns, and you have an IRA in the U.S., if you withdraw money from the IRA, periodic payments, and you take your required minimum distributions, and they withhold 15%, that's the final amount of U.S. tax that you need to pay. You report the IRA in Canada. You get a tax credit for the 15% that they've already withheld, and you have no further U.S. tax filing requirements, assuming you don't have any rental income or any other U.S. source income. In cases where you're a U.S. citizen and you're filing tax returns while living in Canada, even if they do withhold 30%, it's not a huge deal because you will get that back as a refund on your tax return. However, that does mean that they're keeping, an extra 15% for a whole year, and a lot of clients don't like that. So the question I get is, how do I get these brokerages to withhold only 15% on these distributions? Now, if you're not a U.S. citizen, you can file a W-8 BEN, and that should prompt them to withhold 15%. The big challenge here is most of these brokers are not going to withhold anything less than 30% because all they're thinking about is the risk to them. If they get it wrong, then they would have under withheld. So they're taking a very conservative approach in withholding the maximum and letting the clients figure it out. And once again, that's pretty terrible customer service. So I would say, if you're running into this problem, and not even if you're running into this problem, but if you have a U.S. IRA in the U.S. and you're living in Canada, especially if you can be just living in Canada permanently, I would say move the IRA up to a Canadian broker that has licenses on both sides of the border that can help. So if you're in this boat, email me, Phil@philhogan.com, and we can find somebody to help. But once we get the IRA to Canada, then we will be able to do the proper withholding on the account. and won't be constantly withholding 30% on periodic payments. This gets really tricky for non-US citizens, because once that 30% is withheld, the only way to get back the 15%, the difference between what they should have withheld and what they did withhold, is to file a non-resident US tax return. And honestly, that's a pain in the butt. It's very expensive. Just to file a simple non-resident return might cost between $500 and $1,000, whatever it might be, but it's not cheap for sure. So if you can get the proper withholdings done at source, you won't have to worry about that extra cost and headache of an extra US tax return at tax time. So this leads us in, is a good segue to the final question. CRA disallowed my foreign tax credits. What are my options? So in the example previous about the 30% withholdings, I see this a lot. So I see, not necessarily our clients, but new clients might come in and say, I had 30% withheld from my periodic payments from my IRA, so my required minimum distributions. I reported the income in Canada, and once again, this is for non-US citizens. I reported the income in Canada, and then I took a foreign tax credit for the 30%. I got reviewed by CRA. They disallowed everything except for 15%, and now I'm out 15%. What are my options? Now, the option there is to file a non-resident US tax return, recover the 15% that CRA disallowed, or the 15% that the broker withheld in addition to the actual 15% rate. So that's how you correct that. Once again, as I mentioned previously, you want to make sure that they just withhold 15% so you don't have to go through all that. But for the fourth question, the reason we're getting this question quite a bit is because people they're claiming a foreign tax credit in Canada on whatever the US broker withholds. So they might withhold 10%, which is 5% less than they should. They might withhold 20%. They might withhold 30%. The correct amount is 15%. So if they don't withhold the correct amount, now CRA will disallow the difference between what the maximum rate is and the 15%. In these cases, you just have to make sure that the total amount that's claimed for Canadian purposes is correct. So if you're a non-US person, it will always be 15%. And the question I got, actually, this prompted me putting on this list. I got an email from somebody who's been battling the CRA for, this takes forever to get these appeals through. Battling the CRA on a CRA tax credit review when clearly they're not going to win because they try to claim 30% when it should have been 15%. The problem with this is not going to be very clear when you go back and forth with an agent. You're going back and forth trying to write letters. They're not really understanding what you're trying to say. You're not really understanding what they're trying to say. It'd be very clear to a cross-border CPA, but you could be locked in the system forever, sending letters back and forth, back and forth. So at the end of the day, it looks like the tax returns were incorrectly filed. And remember, the reason this takes so long is you might file a tax return in June. It might get, the foreign tax credit calculation might get reviewed in November. You might respond in December, and then they might not get back to you till, February the next year. So this will go on and on. If you feel like they incorrectly assess the returns, then you file a notice of objection. So that might kick it down the road another, 6 to 8 months. All that unnecessary time for something that was relatively straightforward that you should have just claimed a 15% foreign tax credit, or at least they should have just withheld 15%. So that's why I know it can be tough in this environment to find a cross-border CPA, but that's why it's important to get some really good advice on this instead of just filing tax returns and having to clean up a mess later. So I hope those 4 common tax questions, cross-border tax questions, were really helpful. I get these a lot, so hopefully that helps. Once again, doing a quick little podcast in the car here on the way to the office. I will be setting up the podcast studio. I want to thank everybody for subscribing to the YouTube channel. We're almost at 1,000 subscribers, so that's great. If you haven't subscribed to the channel yet, please do so, because I will be uploading this video, and I'll be uploading the new podcast that I've been recording, and I have some really interesting guests in the pipeline for 2023 and 2024. So thanks again to everybody for their support. If you have any questions about cross-border taxes, cross-border wealth management, or planning, please email me, phil@philhogan.com, and we'll see you soon.